Top 3 reasons why gas prices are out of control. Welcome back to Demystified Daily. The United States is an energy-independent state. It is capable of producing and exporting energy, but a rise in gas prices and property taxes is telling a whole different story. Here, we're discussing the top 3 reasons gas prices have hiked up and what will happen in the coming future. To know, please watch till the end and make sure to like and subscribe to our channel. The United States is a country that is sufficient in energy production and is a big exporter of energy. The United States imported only a limited quantity of energy until the early 1950s. To cover the gap between petroleum use and domestic production, the United States began to import more crude oil and petroleum products, such as gasoline and distillate fuels, in the mid-1950s. From 1958 to 2022, the annual rate of energy inflation in the United States averaged 4.43%, with a high of 47.13% in March 1980 and a low of 28.09% in July 2009. Total yearly energy imports have fallen since 2005, while total energy exports have risen. For the first time since 1952, the United States became a net total energy exporter in 2019, and it maintained that position in 2020 despite lower total energy production and consumption in 2020 than in 2019. Crude oil accounts for the largest share of U.S. energy imports on an energy content basis. Some of the imported crude oil is refined into products that are exported. Gasoline prices rise and fall with the price of crude oil, though not always in sync or to the same degree. More than 50% of the cost of gasoline is based on the price of oil, according to the U.S. Energy Information Administration. Inflation in the United States rose to 32.05% in March 2022, up from 25.55% in February. As a result of Russia's invasion of Ukraine, the cost of gasoline increased by 48%, and the cost of fuel oil increased by 70%. This is the highest gas spike since 2014. Now, nearly 9 in 10 car owners are concerned about being able to afford to fill up. At the same time, despite the Ukraine conflict, global oil supplies have increased, notably from Russia, even though the Russia and Ukraine situation has affected the economy of both countries and the countries in support of Ukraine. This means constraint is not driving high pricing. Then, what is? In this video, we will tell you about the reasons behind high gas pricing in the US. Number 1. High demand. The United States is both the world's top producer and consumer of crude oil. The price of oil is mostly determined by supply and demand. Almost 84.1% of the U.S. population is a licensed driver. According to new data issued by the Department of Transportation's Federal Highway Administration, driving increased by 3.5% in 2014, the biggest increase in more than a decade. They demonstrate that in 2015, Americans traveled more than 3.15 trillion miles, or about 337 round trips from Earth to Pluto. The previous record was set in 2007, with a distance of roughly 3 trillion miles. The COVID-19 pandemic transformed the way Americans travel forever. Travel was cancelled and commutes were drastically reduced due to lockdowns and the virus's unchecked early spread. Americans, on the other hand, were back on the road by summer 2021. According to the Department of Transportation, travel on U.S. highways increased 11.2% in December 2021 compared to December 2020, marking the second month in a row that driving exceeded pre-COVID-19 levels. For all of 2021, drivers drove 3.25 billion more miles than they did in 2020. Travel on all roads and streets changed by 4.1%. plus 9.5 billion vehicle miles for January 2022 as compared with January 2021. COVID has changed many people's lifestyles. You can say most of them got fired or left their jobs amid the coronavirus, and now they have started traveling or started a bohemian life. It can be a good explanation for the high gasoline demand. Americans are more out on the road now, and they are willing to travel. But this demand was not served perfectly due to the Keystone XL pipeline cancellation. If you don't know what the Keystone XL pipeline is, let us explain it to you. The Keystone XL pipeline was the fourth stage of the Keystone project, and it was jointly owned by TC Energy Corp and the Alberta government. KXL was scheduled to travel from Hardisty, Alberta, Canada to Steel City, Nebraska via Montana and South Dakota. The KXL was designed to transport 830,000 barrels of heavy oil sands crude oil per day. Existing pipelines would transport the oil to places across the United States, including refineries in the Gulf South. An increase in demand, along with a reduction in supply, is quickly driving up prices at gas stations. The cancellation of KXL can be the supposed reason behind less supply and a surge in demand and gasoline prices in America. Number 2. Oil production has not kept up with the high demand. In late August, Hurricane Ida shut down a huge section of the United States oil drilling and refining capacity in the Gulf of Mexico, according to the Energy Information Administration. Energy traders, most of whom work for the world's top oil companies, banks, and privately held trading houses, are partly to blame, according to experts. While rigs and refineries have quickly reopened, crude oil stockpiles have remained low, indicating a continuing supply shortage. According to the EIA, oil stored at Cushing, Oklahoma, one of the country's biggest petroleum depots, was down 40% from the start of the year. Oil producers, like many other industries during the pandemic, are experiencing a labor shortage. They are also having trouble obtaining some of the equipment they'll need to ramp up production, such as pipes and specialized sand for fracking shale oil extraction. They can't find people and can't find equipment, said Robert McNally, president of consulting firm Rapidan Energy Group. It's not like they're available at a premium price, they're just not available. As a result, U.S. oil production is now just under 12 million barrels per day, down 8% from last year. Experts predict that the sector will not return to pre-pandemic levels this year, and that the prior decade's rapid rises in U.S. oil output, which were regularly in the double digits year after year, will be a thing of the past. The oil bust in 2020 is another issue that is likely making oil firms wary of investing too much too soon. Oil briefly fell into negative territory during the early days of the epidemic, resulting in a slew of industry bankruptcies. Another factor limiting U.S. output is investors' reluctance to invest in fossil fuel stocks. For the past 2 years, major U.S. oil equities have lagged behind the broader market, teaching executives a painful lesson. Use the recent windfalls to reward investors, not to drill additional wells. Number 3. The global energy markets are in a crunch. Aside from local oil supplies slowing, international oil and energy markets aren't helping problems on the supply front. According to CNBC, OPEC and other major oil exporting countries have consistently agreed to just small increases in production, despite pressure from oil consumers such as the United States and India for larger shipments. In December, the cartel agreed to increase output by only 400,000 barrels per day, after President Joe Biden specifically requested increased production to help reduce rising prices. But as some cartel members responded to Biden and other world leaders using their strategic oil stockpiles, it's a difficult balance, a rumored stoppage in manufacturing ramp-up. There have been supply constraints in broader energy markets as well. Natural gas and power costs in Europe have soared, and traders forecast greater oil and other energy prices in the coming months. Russia, a major natural gas supplier to the EU, has held off on increasing exports to the West, causing prices to remain erratic and high. After Saudi Arabia, Russia is the world's second largest crude oil producer, supplying almost a third of Europe's needs. Last week, the price of Brent crude increased by more than a fifth, owing to concerns about a decline in Russian supplies. Russia's ruthless invasion, as well as Western measures to oppose it and assist Ukraine, are spilling over into global financial markets, affecting nearly everyone in the United States and around the world in small and large ways. This shows gasoline is going to stay high for a while, and the Americans will be feeling pain at the gas stations. You can now try the less traveling hacks and tips to reduce traveling. This might help you to reduce the extra dollars you are paying at the station. This is all for today. We will be back with more. Until then, like and subscribe to our channel, and do not forget to press the bell icon and stay updated.